Good morning, this is Ken Long from Tortoise Capital Management with a review of the daily trading plan for July 4th, 2011. We have a bullish normal market. On an annual basis, we're at 61 out of 100 on weekly RSI, 98 out of 100 overbought on a 10-day NDX. Percent stretch above the 200-day moving average is at 6.32%. It's come out of the red and into the yellow. That's a bullish move. Slope of the 50-day moving average actually turned positive at 0.04%. It's still rated as red and bear because it's in the lower sixth of its last 180 days worth of slope value. ADX 14 has pulled back to 20.9 based on this week's strong bullish price action, weakening the bearish trend. ATR percentage at 1.34% is at the very high end of normal. Looking at SPY's gap stats in the last 30 days, 14 times out of 30, the market has gapped down. 7 times it has continued to fail for an average of minus 0.87%. 7 times rebounded for 0.58%. 16 times the market has gapped up. Only 5 times has it reversed to fail for an average of minus 0.39. 11 times out of 16, when it is gapped up, it has continued to gain an additional 0.57. So right now the percentage play is that they will continue in the direction of the gap because 18 times out of 30 it's done that, almost 2/3. The range stat move for SPY remains 1.46%. You can see that the market has come from oversold into overbought conditions where it's been for 4 or 5 days. No signals in overreaction or channeling. The pivot is above 130. At 133.27 inside the IWM, the small caps. That pivot is 83.65. Taking a look at the 10-day min pain, the leaders have been Coke, IBM, Kraft, Johnson & Johnson, and Chevron. The ETF leaders, ILF, Latin America, Taiwan, the Euro, Consumer Healthcare, and Asia less Japan. The 10-day max pain candidates, Procter & Gamble, Merck, and Pfizer, all of which offer opportunities to buy value at a good discount, and then Bank of America and Boeing. Among the ETF 100 losers, VIX, silver, gold, and long bond. You can see how the trend has reversed now in the ADX, with plus DI now crossing over minus DI, and the ADX line itself coming back just above 20. You can see volatility has increased and is right at the boundary of volatile. Channeling signals in silver, gold, and treasuries, and no other patterns to speak of. Taking a look at the Dow 30 tactical, absolutely no other patterns except for the max pain range compression. What I really like here is that the consumer staples, Procter & Gamble, Merck, Walmart, and Johnson & Johnson, all are in ideal conditions to reverse and go north, along with Boeing. Winners from Friday, JP Morgan in a resurgent financial sector. Finance has been horrible, but JP Morgan and AXP, American Express, have been kind of leading the way out of off the bottom. Caterpillar back to its winning ways here at 108. It's you can see how it's been outperforming on the 1 day to 1 month time frame compared to the rest of the Dow. Microsoft, we're going to see in charts of interest, has been exceptional. Among the ETFs, we've got dojis and channeling patterns, silver, gold, long bond, and natural gas. And then you can see the max pain range compression candidates, no other pattern trades. Among the frogs, Chevron and Exxon Mobil. Among the Dow 30, Alcoa, GE round out the top 5. Utilities and basic materials continue to be very froggy, as is coal. Coal is a nice trading vehicle here. It's froggy on a daily, on a weekly, and on a monthly basis. The slope of the 30-day regression line, which turned about 7 days ago to give us an alert of a potential state change, continues to pull away from its 10-day moving average. You can see, although the slope is negative, it's starting to slope upwards. 3 more days of good buying pressure here, and that slope will go positive. And you can see how far it's retraced off this lower channel in the place where you would expect it to. Percent stretch has moved a standard deviation and a half off its 2 SD low here, based on this week's buying action. For your reference, the range stat percentages and the holding X-day periods. I want to draw your attention to the 5-day performance of all these indexes. Most of them are over 1.5 standard deviations in terms of historical gain over those last 5 days. So the market has moved incredibly fast, incredibly far, and for the professional trader, we're just going to be cautious and careful and measure our risk and recognize that after an outperformance period like that, it wouldn't be unusual to see some profit taking. Even on a 10-day return basis, most of them are still over 1 standard deviation. So we saw a little bit of irrational exuberance or significant buying of value at the end of a month. In the Dow Quality Report, I like Bank of America, Hewlett-Packard, and Microsoft based on their 30-60-day quality score divergence. And looking at the ETF 30 as well, we're like in Brazil and Latin America, which have gone from the red into the green and have a very positive divergence and are positive on the 30-day, and not too many symbols can say that. In the safe zone channel, and you see the gap stat numbers up above, you can see how SPY in the last 4 days has broken out of its sideways channel and signals getting stronger. Pivot point calculations for your reference. Looking at the alpha stat, this is where we subtract the slope of the 30-day regression line of SPY from each of these indexes and plot the alpha. So the 0 line is SPYs. Diamonds have held up pretty well, but really small caps, mid caps, and tech have been improving the last 3 or 4 days. That's a sign of the risk-on trade coming back into vogue. Commodities have been relatively suffering, although there is some evidence of turning the corner here. And then the globals, all lagging behind the U.S. However, they are at a natural turning point here at 1 standard deviation below. Wouldn't surprise me to see strength cycle over to Europe again. Lots of things improved on Friday using the safe zone discipline. Spiders, diamonds, Euro-Asia blend, technology, Intel, Caterpillar. And that's everything I want to highlight from the daily. Let's shift. Well, we'll record a separate one for charts of interest. Thanks for your attention. This is Ken Long at Tortoise Capital.